Hi, before this video you should already understand the words and concepts found in financial statements. Okay, so these financial statements are the balance sheet and the income statement. You also should have already watched my other free video on current ratio. Alright, so the topic for this video is financial ratio analysis with a focus on the quick ratio, which is one of the liquidity ratios. Okay. Remember, you can always go back to mbabullshit.com. Okay. So this video discusses and analyzes the quick ratio, which is one of my free videos on liquidity, profitability, and market value ratios, which include these ratios over here. Okay. And after these, you can check out my next videos on mbabullshit.com on financial leverage ratios, which include these, and my turnover ratios, which include these. Right? Alright, so let's get down to it. Let's start with the story. Let's say that ABC Company has $1,000 in current assets and $800 in current liabilities. $100 of the current assets is in inventory. Okay? What is the quick ratio? The quick ratio is very simple. $1,000. Okay, $1,000, which comes from this current assets, minus $100, which is the inventory, all over $800, which is the current liabilities. And in the end, we come up with a very simple answer, which is this. Our quick ratio is 1.125. Now, as you can see here, it is similar to the current ratio, but what's the benefit of subtracting inventory over here? Why are we subtracting this inventory over here? Well, inventory is considered less liquid, or not as easily. Now, when we say less liquid, we mean not as easily convertible to cash. Okay, so inventory is considered less liquid than other current assets. Okay. Why? Because it could be lost. A lot of inventory gets lost in the warehouse or stolen or whatever. It could be outdated, meaning you cannot use it anymore. So take, for example, mobile phones, which become obsolete very fast. Or they could be damaged. So you think your inventory is there in your warehouse and everything is great, but you might not realize that a lot of it is damaged. Okay. So that's why we subtract inventory. So what does now remember, you want the purpose of this, okay, the objective here is to see how much money or assets you have up here, current assets, to pay for your current liabilities down here. But we're subtracting this inventory over here because it is not easily convertible to cash. Therefore, it cannot easily be used to pay for these liabilities over here. Okay? So now, we have our figure of 1.125. What does it mean? It means that the company has 1.125 times the amount of quick assets to pay for its current liabilities. When we say quick assets, we mean assets that can quickly be turned into cash or is already cash. Or in another way, the company has an excess of 12.5% in quick assets to pay for its current liabilities. Where do we get this 12.5%? Comes from here. Okay, this 0.125 is equal to 12.5 in percentage terms. Okay. So this indicates, so remember, it's just an indicator. It's not 100% sure. This indicates that the company will not have any trouble paying its debt, or its debt for the next 12 months. Remember, current assets means And current assets means easily convertible to cash within the next 12 months. Current liabilities means liabilities which need to be paid for in cash within the next 12 months. So the quick assets are more than the current liabilities for the next 12 months. And these quick assets can be used to pay for these liabilities. Okay? In fact, your company or this company has an excess of 12.5% in quick assets. Okay? So if the quick ratio is high, why is this good? Okay, it's good for creditors such as banks which loan money to the company, which need to get paid back within the next 12 months. And if the quick ratio is high, why is this bad? Okay? It might indicate inefficiency in using short-term assets. Why? If you are a stockholder or a shareholder or an owner, you want ABC Company to earn you profit using as little assets as reasonably possible. If there are excess assets, you'll want ABC Company to either give it back to you as the owner because ABC isn't using it anyway, so they might as well give it back to you so that you can use it personally for yourself. Or you'll want ABC to invest it in other projects so that it can earn more profit for the company. Okay? Oh, and another thing is that this could also signal lack of inventory to reach demand. Okay, remember, if your current ratio is high, maybe it's because you have a lot of current assets, but not much inventory. Because remember, you have to subtract the inventory to get current ratio. Maybe you did the reason why you have a high quick ratio is because you did not have much inventory to subtract anyway. So that's why you ended up with a high quick ratio. And if you do not have enough you do not have much inventory to subtract, it means maybe you don't have much inventory. So if you don't have much inventory, maybe you lack inventory to reach the demand of your customers, and that's a bad thing, of course, because then you risk losing your customers who will be unhappy if you don't have any inventory to supply them with. Okay. Now the opposite is also true. If the quick ratio is low, this could be bad. Why? It's bad for creditors, definitely, such as banks which loan money to the company and which need to get paid back within the next 12 months. Okay? If the quick ratio is low, it could be good, because it might indicate efficiency in using short-term assets other than inventory, of course, because it does not include inventory. It shows that, well, if you're a stockholder or a shareholder, you want ABC Company to earn you profit using as little assets as reasonably possible. And if you have a low quick ratio, this indicates that maybe you're not using much assets, but you're still earning a good amount of profit, or you could still be earning a good amount of profit. Okay. Now, what are the flaws of this ratio? Where the first flaw is that a high quick ratio may give a false sense of security to creditors by treating all current assets and liabilities minus inventory equally. So, for example, your company has little or zero cash but has quick assets worth $105, which can be converted to cash after 11 months. So let's say all your current assets less your inventory equals $105, for example. Okay? But you also have accounts payable in the amount of $23 to be paid next month. Okay? So your quick ratio is a very high and ultra healthy 4.57. Okay? But next month your company will be toast. Why? Because this $105 can be converted to cash after 11 months. This is only $23, but it must be paid next month. So you will be toast even if you have a quick ratio of 4.57. Okay, by the way, quick ratio is sometimes also known as acid test ratio. Okay. So what's the second flaw? Or what are the flaws of this ratio? Part 2. Well, a low quick ratio may give a false sense of danger. Your company has little or zero cash, okay, and has quick assets of $105 and accounts payable of $100. So looks like this company has a dangerously low quick ratio of 1.05 and could be in trouble very soon. But what if the company has a big line of credit with banks, okay, such as like in the case of the current ratio, which they can easily in which case they can easily borrow cash to pay for these accounts payable anyway. So they're okay. I mean, this company is fine. This company will not collapse because they can borrow cash. Or what if this company has very fast moving inventory anyway? Remember, in the quick ratio we subtracted inventory here. We did not include it because we assume that inventory is not easily convertible to cash. But in some businesses, inventory is very easily convertible to cash or is very fast moving, so it becomes cash almost instantly. So in this case, okay, even if you have a low current ratio, quick ratio of 1.05, you will not have problem, or you will not have a problem, or the company will not have a problem, because this inventory will turn to cash very soon anyway. Okay, so an example might be, I don't know, a McDonald's shop. I would think that a fast food shop would have inventory which turns into cash very quickly. Okay, unlike, for example, a car shop or a car showroom. Okay, if they're not selling any cars, then your cash is stuck and frozen within the cars until you can actually sell the car. But in a fast food joint, okay, the inventory gets sold very fast. Okay, so let's look at the traditional analysis of this ratio. First is to compare the historical quick ratios of your company, or of this company, if it's not your company. If the quick ratio is higher now than last year's, then either it's in a more stable or less risky debt situation than before, or it's more efficient now than before in managing assets, or both of the above. If the quick ratio is lower now than last year's, then either it's in a more risky debt situation than before, or it's more efficient now than before in managing assets, or both of the above. Okay. The second form of traditional analysis is to compare the quick ratio to that of companies in a similar industry. If the quick ratio is higher than similar companies, then either it's in a more stable or less risky debt situation than them, or it's more inefficient than them in managing assets, or both of the above. Okay, when we say inefficient than them in managing assets, well, it's using so much assets just to generate cash or just to generate profit. Remember, from the owner's point of view, it's better for a company to earn the same amount of profit but to use a lot less assets, a lot less current assets, a lot less quick assets. Okay? Or, of course, both of the above. All right? If the quick ratio is lower than similar companies, then either it's in a more risky debt situation than them, or it's more efficient than them in managing assets. Maybe it's using less assets to generate the same amount of profit, or both of the above. Okay, so that's how simple it is. So remember to share it if you like it on Twitter. Follow us on Twitter at MBA Bullshit, or go to Facebook and look for us, facebook.com/MBA Bullshit, or just forward my YouTube links on your email. Have a great day and goodbye.